What to watch out for after the partial resolution of the US fiscal cliff? Herwig van Hove, responsible for strategy and development at Notz Stucki, is here with us to discuss market outlook. Herwig, thank you for coming.
Thank you for having me.
Republicans and Democrats reached a last hour arrangement at the end of the year, but the debt ceiling is still looming. How threatening is this?
Thank you. I think this is a very pertinent question. As you know, yesterday at the conference we expressed rather an optimistic view for 2013, and we do want to caution for too much complacency around this fiscal cliff. People have gotten quite used to solutions of the 11th hour and the notion that come what may, people will not, or the Republicans and the Democrats will not allow for this to go haywire. However, as you may remember, in the summer of 2011, we had another debt ceiling discussion. We went over the due date, and markets corrected with 17%. And this was in a context where both Republicans and Democrats were saying, we will solve the problem, we haven't met the deadline, but we will do it, and we will in no circumstances let the US default on its debt. Today, we have a very different situation. We invited a specialist from Washington, from one of our managers, to come and inform us about this. And he said that in his 20 years of experience in the White House, he has never seen a situation so tense between the two parties. They are literally no longer on speaking terms. Obama has put his foot down on the debt ceiling, saying that he will not give any concessions for increasing the debt ceiling. And the Republicans feel that they have basically done what they're able to do. Now, we don't want to be alarmist. We also believe that the chances for a resolution are higher than for it to really go completely bust. But we do think that the market has become too complacent about this. It is just trading as if this is a non-event, and it is not. So we think there's going to be some volatility probably by the midst of February, when people become more scared of these due dates, which are March 1st and March 27th.
And in this context, what is the global outlook for 2013?
As I indicated, we are optimistic. Optimistic because basically many of the global companies are doing very well, are in very good shape. But more importantly, because many of the uncertainties that have hindered us in especially 2011, a little bit less so in 2012, are now no longer, or far less present. I mean, if we go around the globe, in the US, housing seems to be on a rise again, and that's a very important driving factor for the economy. The government has been a big hamper on the economy because it was firing a lot of people. That is stopped now. The banks have written off a lot of debt. Their balance sheets are in much better shape, so they're providing credit again. And then we have this sort of joker card of the shale oil industry, which is nascent, but which will become a very big employer and a very big source of capex and investments. So the US seems to be on a trajectory where they can go back to around 3% growth, and that would be a big stimulus for the world economy. China, which has been a huge detractor of growth for the last, I would say, 18 months, that was due to a rather unruly transition of power, which is not usual in China. The Bo Xilai incident was quite complicated, and so entrepreneurs in China, in a very orchestrated economy, did not invest as long as they did not know what the new power base would look like. That uncertainty has completely been taken away, and therefore the figures that are coming out of China now are very, very positive. And then thirdly, Europe. We have elections in Germany in October. I think that means Germany will do whatever it takes to keep Europe together. Eastern Europe is on fire. The economies are going well, and they are becoming quite well advanced also in technology. So we feel a lot of uncertainty has been taken away. Companies are in great shape, and therefore we are quite optimistic for 2013.
In terms of allocations, equity versus bonds, where's the value?
Well, the other interesting takeaway from our dinner, and this is by no means an out of consensus view, was that what is traditionally considered as the riskless asset, government bonds of very stable governments, is probably becoming slowly but surely the investment that has the biggest chance of losing you money going forward. Now, none of our managers is in a position where they are already starting to short these instruments because the timing of this is very complicated. But it is clear that government bonds will not bring you a lot of joy going forward. The yields are just too low. On the corporate side, if you look, we had an anecdote of one of the companies we're obviously invested in here in Switzerland, which is Nestlé. If you look at Nestlé, you're getting a dividend yield of over 3, and the corporate bonds are rewarding you far less than that. So to us, this is just an anecdote, but it is true for many companies. So for us, the best risk reward can now be gotten in equity, much more so than in bonds.
Herwig, thank you very much for joining us today.
Thank you.